Let me ask you something real quick. Do you know what your credit score is right now? Not roughly, not I think it's decent. I mean, do you actually know the number? Because here's what's wild. Most people have no idea. And the ones who do check, they usually just feel vague anxiety about it and close the app. Sound familiar? Here's the thing. I used to be that person too. My name is Deshaun, and about 2 years ago, I was trying to rent an apartment in Atlanta. I had a steady job, money in my account, and I still got denied. The reason? My credit score was 618. The property manager looked at me like I'd shown up to a job interview in pajamas. That moment changed everything for me. I spent the next 6 months going deep on how credit scores actually work, and what I found shocked me. The system isn't broken. It's actually designed very precisely. It's just designed to benefit lenders, not you. But here's the good news. Once you understand the actual rules, not the watered-down advice you get from random blogs, you can use those rules to your advantage, legally, completely legitimately, and way faster than anyone tells you is possible. I went from 618 to 741 in about 4 months, and today I'm going to show you exactly how. Welcome to Smart Invest, and I spend way too much time thinking about how credit scoring actually works behind the scenes. If you're someone who feels like your credit score is stuck and you don't know how to move it without waiting years, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Okay, so let's get into it. The problem with conventional advice. Here's what most people don't realize. The standard credit advice you get, pay on time, keep balances low, be patient, isn't wrong. It's just incomplete in a way that costs you real money. Every single month you spend with a fair or good credit score instead of an excellent one, that's a tax. A hidden tax that shows up in your mortgage rate, your car loan, your apartment application, even your car insurance in most states. According to data from the Consumer Professional Bureau, borrowers with scores below 670 pay on average 1.5 to 2 full percentage points more in interest on mortgages than borrowers above 740. On a $300,000 home loan over 30 years, that difference is over $100,000 in extra interest for the same house, same neighborhood, same everything except the number on your credit report. And the frustrating part is that most people are told, just wait, build history over time. It'll improve eventually. Now, you might be thinking, okay, but isn't credit history literally about time? Like you can't speed up how long you've had accounts open, right? Actually, you kind of can. And that's exactly what I want to show you today. How credit scores actually work. Look, before we get to the strategy, you need to understand what a credit score is actually measuring, because most people think of it like a grade. You either did good or you didn't, but it's more like a risk prediction model. A FICO score, which is the one used by about 90% of lenders, is essentially asking, based on this person's history, how likely are they to miss a payment in the next 24 months? That's it. And it calculates that prediction using 5 main factors. Payment history is the biggest one, about 35% of your score. Have you paid your bills on time? Next is credit utilization. That's how much of your available credit you're actually using, which is about 30%. Then comes length of credit history at around 15%. After that, you've got credit mix and new credit inquiries, which make up the remaining 20%. Most people focus on payment history, and yes, that matters enormously, but the credit utilization factor and the length of history factor, those can move fast if you know what you're doing. This is where it gets really interesting. Let's talk about the authorized user strategy first, because this one had the biggest impact on my score personally. The authorized user strategy. So here's the mechanism. When someone adds you as an authorized user on their credit card, that account's full history gets imported onto your credit report. The age of the account, the payment record, the credit limit, all of it. Read that again, because people gloss over how significant this is. If your aunt has a credit card she's had open since 2001, perfect payment record, low balance, and she adds you as an authorized user today, That 24-year-old account now shows up on your credit report. Your average account age could jump from 3 years to 14 years overnight. Now, she doesn't have to give you a physical card. She doesn't have to give you access to the account at all. The addition is purely for credit reporting purposes. And she can remove you anytime, which makes this very low risk for her. I'll use myself as an example. When I was at 618, I had 4 accounts. 2 credit cards I'd opened in my early 20s, a student loan, and a car note. Average account age about 2.5 years. No major negatives, just a thin file and a missed payment from college I was still dragging around. My uncle had 2 credit cards, one from 2003, one from 2008. Both spotless. Combined, a limit of about $40,000. Utilization sitting around 4%. He added me as an authorized user on both. Within 2 billing cycles, about 45 days, those accounts appeared on all 3 of my credit reports. My average account age jumped to over 11 years. My total available credit more than tripled. My score moved from 618 to 703. That 85-point jump right there meant I qualified for a car refinance that dropped my interest rate from 11.4% down to 6.1%. On a $22,000 balance with 3 years left, that saved me about $3,400. Now here's what makes this powerful and legitimate. The authorized user system was built intentionally into FICO's model. It originally existed so that stay-at-home spouses could build credit through a partner's accounts. Over time, people realized that works beyond just spouses, and FICO has kept the mechanism in place, even adjusting for it over the years. It's not a glitch, it's not a hack, it's a documented feature of the system. Banks just have no reason to tell you about it. Now, you might be thinking, okay, but what if I don't have a family member with great credit? That's a fair point. There are actually paid services called trade line companies that rent authorized user spots on high-limit aged accounts. I want to be real with you. This is a gray area. It's technically legal, but some lenders flag it during manual underwriting. I'd only recommend the family or close friend route. It's cleaner, it's free, and it holds up under any scrutiny. Okay, so the second thing that moved my score fast was understanding exactly when utilization gets reported, because most people get this wrong. Here's what most people don't realize. Your credit card company doesn't report your balance to the bureaus on your due date. They report it on your statement closing date. Those are 2 different days. So let's say you put $2,000 on a card with a $3,000 limit every month. For groceries, gas, subscriptions, whatever. And every month you pay it off in full before the due date. Great, right? No interest, responsible usage. But if that $2,000 balance is still sitting on your account when the statement closes, that's what gets reported. You're showing 67% utilization. Your score is taking a hit even though you never paid a cent of interest. The fix is simple. Pay down your balance before the statement closing date, not just the due date. Bring it down to under 10%, ideally under 3% before that date. Then your reported utilization looks pristine. I did this in 1 billing cycle and saw my score jump another 22 points. It sounds almost too simple, but the math checks out. Utilization is recalculated fresh every single month. There's no memory, so past high utilization stops hurting you the moment you report low utilization. Here's another one most people completely overlook. Utilization is a ratio. You can improve it by lowering your balance or by raising your limit. Both work. Many major card issuers, American Express, Chase, Discover, allow you to request a credit limit increase directly through their app or website with what's called a soft pull. No hard inquiry, 0 impact on your score. If you're carrying $1,500 on a $5,000 limit, that's 30% utilization. Get that limit raised to $10,000, and suddenly you're at 15% without changing your spending at all. I request increases on every card I have every 6 to 12 months. Takes maybe 10 minutes total. Over 3 years, I've watched my total available credit go from $11,000 to over $47,000. That alone has a meaningful impact on my score, and it signals to lenders that multiple institutions trust me with higher limits. All right, here's how to put this all together depending on where you're starting from. If your score is below 650, the authorized user strategy is your biggest lever. Find a family member or close friend with an account that's at least 8 to 10 years old, excellent payment history, and low utilization. Ask to be added. While you wait for that to report, pay down any balances you have to under 10% before your next statement closes. If your score is between 650 and 720, you're in the optimization zone. Request credit limit increases on all your existing cards. Tighten up utilization timing. If you have a thin file, meaning fewer than 4 or 5 accounts, the authorized user strategy still helps significantly. If you're above 720, you're in solid territory, but the difference between 725 and 775 is still real money on a mortgage. Focus on utilization under 3%. Keep your oldest accounts open and active even if you barely use them, and continue requesting limit increases annually. And regardless of where you are, pull your credit reports from all 3 bureaus at annualcreditreport.com. Studies from the Federal Trade Commission found that roughly 1 in 5 credit reports contain at least one error that could affect the score. Disputing legitimate errors is completely separate from everything we've talked about today, but it can have an equally big impact. Look, I want to leave you with this. The credit system was not built for your benefit. It was built by lenders, for lenders, to predict how profitable you're going to be as a customer. The less you understand it, the more profitable you are to them. But the rules aren't secret, they're knowable. And once you know them, you can optimize within them, completely legitimately, in ways that put real money back in your pocket, not decades from now, within months. When I was at 618, I felt stuck, like I'd made some mistakes and now I just had to wait out a sentence. I didn't realize I was operating with incomplete information about a system that had actual mechanics I could understand and work with. The gap between someone with a 640 score and someone with a 760 score isn't always about how responsible they are. Sometimes it's just about what they know. Now you know. If this video helped you, please hit that like button and subscribe to Smart Invests. I put out videos every week on building real wealth without needing to already be wealthy to start. Drop a comment below and let me know where your score is right now and what you're working toward. I read every single one. I'll see you in the next one.